You're listening to Discovering Multifamily, where we discuss all educational topics in commercial real estate with an emphasis on multifamily apartment investing via syndication. And now, your hosts, former NFL fullback Brian Leonard and Anthony Scandariato.
All right, everybody, welcome back to another episode of the Discovering Multifamily podcast. I'm one of your hosts, Anthony Scandariato, here with Red Knight Properties. And today we have a special local guest, at least local to my company in New Jersey, Peter Vander with Aislinn Mortgage. He's a licensed mortgage loan originator in New Jersey. He's been doing this for quite a while. Aislinn has a very, very good reputation in New Jersey. They do a lot of deals. And today we're going to talk about kind of Peter's experience in the mortgage industry as a whole, and also what he's seeing moving forward. We're going to specifically talk about, there's been a lot, and this show is primarily on multifamily, but it does relate to residential and what is happening in that market too. They're kind of intertwined in some sense. And obviously there's competition between single families. There's even competition between apartments and units that are 2 to 4 units, because technically those are in like a single family home that maybe have been converted over time. And you're seeing a lot of activity in terms of demand for rentals in that space. But Peter's on the mortgage side, so he could talk financing all day. So we're happy to have him on. And I guess what I'd like to start out with, we're recording this kind of mid-May, and you know where he thinks we're going in terms of rates for typically 30-year mortgages is what Peter's dealing with. He does some other products as well, but you know, there's been a lot of talk about you know, a possible legislation or executive order that was passed in terms of increasing mortgage rates over a full percentage point for borrowers with good credit. So I kind of want Peter to talk about that and, you know, explain what happened and the impacts of that. And then we'll get into, you know, a multifamily, house hacking, etc. So thanks for coming on, Peter.
Thanks for having me. Appreciate it. I was looking forward to this. So yeah, happy to talk about the recent LLPAs, we'll call them loan level pricing adjustments, to get into the first topic you mentioned. So recently, the Federal Housing Finance Administration, the FHFA, they are the body that makes up the regulatory, the regulations surrounding Fannie Mae, Freddie Mac loans. Sandra Thompson, they recently increased, they redistributed these pricing adjustments. Now, you see a lot in the media right now, which the media gets me going crazy right now because there's so much misinformation out there. And you hear that, oh, if you have a good credit score, you're getting penalized. If you have a bad credit score, you're being rewarded. And this just simply isn't true. Whether or not the recent changes were a good idea or not is up for debate, but here's basically what happened. We have these things called loan level pricing adjustments. They've always been a thing, and it's how person A gets a rate versus person B and person C, and why those rates are different, right? So there's different adjustments to the interest rate based on certain factors. Credit score is one of them. So the recent adjustment was with the credit score. What happened was the FHFA made this change because from their reasoning, it was to mitigate risk and distribute risk out over a greater number of people. Now, whether or not that's the case, that's what they said. But what they did was they created a new credit score bracket. So you used to have, it's like 20-point brackets. So 740 to 760, 760 plus. 760 plus was that top, and it goes all the way down, you know, to 600 and even lower. But with the new adjustments, they created 760 to 780, and now 780 plus is going to be your highest bracket. So they did tack on additional fees for the top tier, and they reduced the fees for the lowest tier. So your borrowers with lower credit scores, but they really just redistributed. If you have a lower credit score, you're not getting a better rate than someone with a high credit score on the same product, apples to apples. You're just not.
Is there a a number? I mean, I guess it depends upon the loan amount, but to using, let's say, 500,000 as a loan amount, is there like a number of like on a $500,000 loan for the FHFA, what type of fees would they charge for someone with that lower versus the higher? And is it like really monumental in the grand scheme of things?
So, okay. All right. So, all right. So $500,000 purchase, you're looking at a $475,000 loan amount with 5% down. 125 basis points of that is $593.75. So in the grand scheme of things, you're making a $500,000 purchase, and with only 5% down, you're only paying $600 on it. Now, this is a way that risk is mitigated with loans, right? Rate increases, like rates are priced out to mitigate risk, because if there was the definite expectation that everyone would repay, then there would be no risk, and but there is risk. So basically, these pricing adjustments are put into place to mitigate that risk, make sure that the investor makes their money back on the loan.
Right. So that risk mitigation adjustment, is that a one-time charge or is that spread out over the life of the loan?
Yes, so that is a one-time charge. And another thing that a lot of people that I've spoken to are confused about is anyone who has an outstanding mortgage already is not impacted by this whatsoever. Their current mortgage is not going to get increased. It's going to stay the same. This is only for new loans, and it's only a just a one-time fee in the beginning. And that
So
can be built into the rate.
built into it. Okay, so they're not getting charged a higher interest rate or a lower interest rate. It's completely separate from that. It has nothing to do with the way that the rates are calculated, correct?
Yeah, I mean, it's kind of a tough question because everything is kind of built into the rate. So you can build this charge into the rate, or you can pay it up front, however you want to do it. Typically, it just gets built into the rate, but it's such a small increase that you're not even really going to see it.
Right. And it's typically being funded at closing regardless. So moving forward, as you pay your mortgage, you really you almost forget about it in a sense because you already paid it at closing for I assume most people.
Yeah, yeah.
So yeah, that kind of clears the air on that because there's a lot of fear porn, I would say, on the internet saying, "Oh, rates are for the best credit borrowers, whether you agree with the policy or not, are being increased from a point to 2 points." So if rates are in the sixes, you're paying 8%. It's not reality. So those people and I could point out a few, but on YouTube and Instagram are just trying to get some clicks. So just be careful who you listen to. Can you kind of talk about, and we're mostly commercial multifamily, so anything 5 units and up. Can you talk about, I guess in New Jersey, obviously you cover New Jersey, there's a lot of urban markets in New Jersey, so there is a lot of multifamily housing, 2 to 4 units. Has anything changed on that front in terms of did this loan level price adjustment hit across the board, or was it just single family?
So it is across the board. As far as what it's done to the market is absolutely nothing. Right now, we have a severe inventory shortage in New Jersey. A lot of people are waiting for this reduction in market prices, and you can kind of see that on the West Coast. So you see a lot of headlines that are like national headlines, and it just doesn't apply to this area. And real estate is hyper local, right? Every market is different. Bloomfield is different than Newark, is different than Montclair. There's different streets that are different in these towns, different sections of the towns. But in the Northeast, in New Jersey, right outside the city in particular, we're definitely looking at very low inventory, high competition. So in the urban areas, in the more suburban areas, competition tends to lower a little bit, but even still in those suburban areas, it's crazy right now.
Yeah, no, absolutely. but you're still seeing, are you seeing the same competition on multifamily versus single family?
So multifamily is very highly sought after. I think a lot of people, especially millennials, uh, people who are looking for a way out of the rat race. Like many people have read Rich Dad Poor Dad. That was one of the books that got me into the idea of investing in real estate and achieving financial freedom. So the idea of financial freedom, I think, to the millennial generation, I mean, I know this is the case with myself. It's, it's something that really resonates with a lot of people. And multifamily as a way of achieving that it's a very realistic goal. So that being said, yeah, I mean, the competition around multifamilies is not only are there fewer multifamily houses out there, but it's also one of those things like if it's cash flowing and it makes sense to hold on to it, like why sell really? Um, and I guess some of the people who are getting later into their careers, those are the people right now who are saying, look, prices are high right now. Let me put this house on the market and just get it off my hands, and then use that as a means to kind of slow down my business a little bit.
Right. And are you seeing with the multifamily side, are you dealing with more investors or are you dealing with more owner occupants?
It's kind of 50-50, and the investors are the ones who have kind of been hitting lately. The owner occupants, I guess, to an investor, it's all about the numbers. If the numbers work, then it's a good deal. So I'm working with people in different parts of the state. I'm working with someone in Atlantic City right now who's getting good numbers because the taxes are lower down there. Um, and but it's kind of 50-50. Like a lot of my buyers, because they're more emotional, they don't necessarily they think they want to get a good deal, right? um they don't want to feel like they're being ripped off if they're paying above asking, but in reality a lot of the listing agents are putting the houses on the market for lower than they're going to get in this market, just to kind of drive competition. So to a buyer, that makes people it makes people kind of think they're getting a bad deal.
Yeah,
And I think that's kind of holding a lot of people back.
sure. And when you talk about on the multifamily side, and from what we're talking about, again, just to clarify, is typically 2 to 4 units, at least in Peter's space. What are you seeing in terms of interest rates on owner occupants versus investor loans? Like, is there a big spread between the two? And let's talk a little bit about interest rates as well.
Yeah, so there is a spread. I believe last year Fannie and Freddie increased the loan level pricing adjustments on investment properties. I mean, you can kind of like play with uh, you know, credits and buy downs and whatnot to get the rate to where the numbers work, but there is going to be a spread, and it's going to be around 1% ish, apples to apples. So if like say the same amount of like if you're not buying down the rate, we call that the par rate. So you're not buying down the rate, you're not getting any credit on the rate. The par rate is going to be higher for an investment property. And again, LTV matters, credit score matters, a lot of different factors in pricing out these loans.
Yeah, typically on the investment properties, you need at least 25% down, right?
Yeah, I mean, 25 is really where the numbers start to work too. Conventional investment property, you can yeah, you purchase with 25% down. Um, DSCR, which is it's an investor purpose loan. It qualifies based on the income of the property as opposed to the income of the individual. Those loans, we can do 20%, even in some cases 15%. But if you're putting 15%, like the numbers just don't work. So like true investors who are buying property in this market are putting down 20 to 25%, and in some cases even more.
Yeah. And what about the owner occupants for multifamily and house? Do you see a lot of house hacking going on?
Yeah. So house hacking is it really allows you to get into a property with so much less down, pay for your mortgage. It's really a awesome thing. Um, you can put 3.5% down using an FHA loan and buy a 2 to 4 family house. Um, Now the caveat is that it needs to work. There's something called an FHA self-sufficiency test. So 75% of the income of all the units of the property, including the one that you're occupying, needs to be greater than the pity payments. So your principal, interest, taxes, insurance. But provided that works, 3 families, it's a little more difficult to make it work, but it does work, especially in those higher rent areas. FHA is an amazing way to get into a multifamily house as a first time buyer and significantly reduce or even cover all of your monthly pity payments. It's really an awesome way to get a leg up.
Yeah, especially for those looking to dip their toes in, and it's not for everybody, but it does work. I've personally done it myself. How many times can you do that house hacking with the FHA loan, or is it case by case specific?
So it's kind of case by case. You're technically supposed to have one FHA loan out at any given time. There is a caveat. If you move a certain amount of distance from that property, you can use it again. I think it's more than 80 miles or something. It might be even more than that. But generally speaking, you're going to move into one place with an FHA, and then your following house hacks are going to be with a conventional loan or something like that.
Yeah. So you're seeing a lot of, I'm sure the competition on those, like you mentioned, are the 2 families. I would have to imagine are pretty fierce because the inventory is just not there. Um,
And the two families are at a price point that more people are comfortable with too. Like when you, especially in this area in Essex County, I'm in Essex, I'm Bloomfield. The 3 to 4 families can get upwards of 750 to a million and plus.
yeah, no, absolutely. Affordability is a key component right now in this market from everything I'm hearing. Let's talk about interest rates. So what are you seeing, on both single family, the 20% down, best credit, owner occupied, and then obviously you mentioned there's about a 100 basis point spread between that and the investor loans. So what are you seeing right now, and how are the interest rates measured, and how are you forecasting interest rates moving forward?
So first off, I'm going to preface this with, just for compliance purposes, this is not a quote for anybody. This is not a specific, this is what you're going to get. Interest rates are always changing. Um, Pretty
May
much right now
15th,
with,
2023.
I'm
That's where
sorry.
we're
Oh,
at.
yeah. Yeah.
Yeah.
So, with a single family conventional purchase, you're looking in the mid to upper six range generally. You can get a little bit lower than that potentially if you buy down the rate a little bit. Um, FHA, you're looking in the mid fives to upper fives. So FHA has a lower rate than conventional. You are paying mortgage insurance throughout the life of that loan. So conventional, if you have 20% down, you're not paying mortgage insurance. FHA, doesn't matter how much you put down. You could put down 95%, you're still paying mortgage insurance. If you put down greater than 10%, that goes away after 10 years. But for the investment loans, yeah, you're seeing about a percent higher than that for conventional. FHA does not do non-owner occupied loans.
Yeah. Is there buy downs for FHA as well? You mentioned something about buy downs previously.
Yeah, so there's a couple types of buy downs that you can use on conventional and FHA, VA, all those standard products. And there's temporary buy downs and there's permanent buy downs. Now to lead into where I see the rates going, I will say that well, let's do the permanent buy downs first. So you purchase the rate down by bringing more to the table at closing, or you can get a seller credit to pay for that permanent buy down as well. That's a one-time fee and it lowers the interest rate. So for example, say you would be at like a 6.5% rate. maybe you pay, you know, a 0.5%, and you get that rate lowered by, I don't know, an eighth of a percent, something like that. So you're paying money at closing to lower that rate. You do that with FHA and everything too. The temporary buy down, and I think it's a good idea still to use the temporary buy down, because I do see the rates coming down in the future. So the temporary buy down, what happens is you're getting a credit from the seller to prepay interest for 1, 2, or 3 years. So how this looks is you'll see numbers. You'll see like a 2-1 buy down is kind of the standard, if you would call it that. And what that means is the first year of the loan, say your starting rate is 6.5%, your year one rate is going to be 4.5%. That's the two. 6.5 minus 2 is 4.5. The second year is the one of that equation. So you would be at 5.5%. Then the third year, it's going to go up to 6.5, which is the technical starting rate. So that's a 2-1 buy down. There's also 3-2-1 buy down, where it's 3% less, then 2% less, then 1% less. So that's a really good play right now, because inflation is the biggest driver of interest rates at the moment. Our inflation over the past couple of years since coming out of COVID has been particularly high. If everyone, I'm pretty sure you've heard it, Anthony. I know everyone that I talk to says, I went to the grocery store the other day and my bill was like $500 and I only bought like 3 items. And that's inflation. So that inflation is coming down right now. The Federal Reserve has been increasing the Fed funds rate to attack that inflation. That's another misconception that people have too, because the Fed funds rate is not the mortgage rates. But I'm kind of going on a little bit of a tangent here.
Yeah, yeah. Talk about that, because a lot of people are. I mean, it does affect it in some respects. Even I get calls that are like, "Oh, Federal Reserve raised interest rates again," but then the treasuries go down. So actually, commercial is a very different story, because we're generally quoted a spread over the treasuries.
Mhm.
So, like, and obviously, if it does have an effect, but sometimes it can do the opposite effect.
Mhm. And mortgage rates typically, 30-year fixed residential mortgage rates typically follow the 10-year treasury, with inflation and the Fed funds rate. So during 2020 COVID, the Fed introduced quantitative easing. Now, what that means is they're purchasing mortgage-backed securities, they're purchasing treasury bonds at an unprecedented rate, right? They were trying to keep our country from collapsing. And what this did was it lowered interest rates. But as soon as they let their foot off the gas, the inflation starts going up. Now what they're doing is they're increasing this Fed funds rate, which affects the mortgage rates to an extent, but it is not mortgage rates. And this is to lower inflation. So the mortgage rates are kind of like where we see the Fed funds rate going. So right now we're looking at the Fed. The Fed just hiked the rates another 25 basis points. And next month, we're anticipating nothing. We're anticipating them to hold the rates where they were. So when we look at the CPI report that came out last week showed really good, expected inflation data. So that brought the rates down a little bit. Rates over the past week have been coming down. But as we get into the future and we see this inflation come down because the Fed is hiking these rates, the mortgage rates are actually going to drop too. And we are expecting the Fed to start cutting the Fed funds rate. It's kind of like 50-50 what economists expect right now, beginning in as early as July. So we don't know what's going to happen, but it's kind of already pricing into the mortgage rates. And that's why we've seen rates come down in the past 2 weeks.
Yeah, I guess we'll see what happens. You mentioned a as we wind down the show. A lot of good information. I don't want to overwhelm people, so I want to keep it somewhat short. You mentioned it's a 2-1 buy down structure.
Mhm.
What are the risks with that versus just a straight up 6.5%, fixed rate loan?
So there's really no risk with a 2-1 buy down. With a 2-1 buy down, it's essentially prepaid interest. So the seller is paying for that interest up front, and you're realizing the benefit over a 2-year period. If you wind up refinancing or selling before that, the amount of interest that was paid down gets credited back to your principal. So when you refinance, even if you do it early, before those 2 years, that money is going to get added to the principal. So you're looking at a lower balance when you refinance.
Okay, that makes sense. So it's not a variable rate loan. It's nothing that matures in a couple of years, correct? Because there's a lot of misconceptions around that as well.
Correct. Yeah, no, nothing matures. You have this set period of I don't even want to call it a discount because it's just upfront paid interest that the seller pays for you. So they're helping you out with your mortgage payments for 2 years, and then it goes back to normal. And like I said, with the rates coming down, it's a good play right now because you're probably going to refinance anyway. So if you can save some money in the meantime, could be a good option. It's not for everyone. It also makes the offer a little bit weaker on the house because you need to get that seller credit. So it's another ask for a seller to give you that credit for the buy down.
Right. I guess it depends on your loan amount and how much interest is it, and it could be significant, especially at the higher price points.
Yeah, definitely.
I totally agree with that. Peter, as we wind this down, a lot of great information. Where can my audience find you, connect with you? And if they're interested in looking at getting a mortgage, what's the best way to reach you?
Sure. So I'm probably most active on my Instagram account. I'm just Loan Officer Pete. You could also find me on LinkedIn. But yeah, I mean, those are like the general spots you can find me.
Awesome. Well, we'll have a link to Peter's Instagram and LinkedIn in our social media and iTunes description. And if you liked what you saw and or heard, please give us a rating and review on iTunes. It helps my message and Peter's message get out to a greater audience. That's just the way the algorithm works. So we really appreciate that. And Peter, thank you so much for coming on the show today and providing all this valuable information for our audience.
Thank you so much for having me. I had a good time. This is my first podcast that I recorded, so kind of cool.
You did a great job. Thanks, Pete.